Welcome to the Lowdown. I'm Michael Smith, and joining me today is Chris Roberts. Chris, welcome to the show.
Thanks, Mike. It's been a while since I've been on.
Well, it's been a while, and a lot has happened. I thought, today, especially this week, we've seen such a big change in the markets. Finally, a pause in volatility, which is, I think, quite refreshing considering the first part of the year. We've had lots of volatility. The market's been down. Almost everything's been down, just in general. So I think many investors, many people are just waiting for a nice pause in volatility, and it's pretty interesting. You read, the news articles and the headlines, and already calling for this may be the turn. But I think you and I both have a lot of things we'll probably continue to talk about, because I would caution that while there's been some improvements and things this week, certainly, and it's nice, I'd be very cautious before I start calling this the turn. Yeah. What are your thoughts on that?
Well, and that's absolutely right, Mike. When you had Kevin on the show last time, you guys talked about the eagerly anticipated potential Fed pivot and how that could help create some jet fuel for markets to turn around. But I think what's important to remember is that despite the fact that we've seen a pretty good rally this week, and there's a number of reasons for that, at least at the time of us recording this show, there's a lot of other economic indicators out there, a lot of noise, a lot of things that we're watching really closely that still paint a pretty, obscure picture for where the economy is headed going forward. I wouldn't say that a few days of exhaling rallies here is a great sign to say, hey, this is it, this is the time to get back in, or something like that. And ultimately something that we've talked about a lot on the program, especially when I've been on here, is not trying to time this turnaround, right? And I think that kind of helps us go into our next topic for today's program, which is our three big themes, right? Don't run, don't panic,
sure,
and stand your ground. And I'll let you kind of pick up that conversation.
Well, kind of going to that, I think in the past, if you think about it, when I got into business in about '97, right? You think about a change in narrative. The Fed came out and said if they're going to raise rates, if they're going to lower rates, that narrative tend to last about a year, if not longer. It just seems like narratives lasted for a while. You could had time to breathe. You knew what was happening. You're in a recession. You're in a recovery. If you think about it now and fast forward to post-pandemic, when we had the biggest increase of the money supply we've ever seen, and now it seems like the shifted narrative is constantly changing at a pace that I don't think anyone could put. And going back to what you said, you can't try to time this. Yeah. And the narrative is changing so fast, it would make it nearly impossible for that to happen.
Well, and that goes back to some of the market mechanics we see, in today's economy, in today's market environment, right? It's not the same thing that you saw in the 80s where, I've got one phone on one ear and one phone on the other ear. I mean, it's this, I talk about it often with our clients. You and I talk about it internally as well, as this idea that we have one high frequency of algorithmic trading, but then also a free flow of data as well. Whereas the narrative in the past would have changed faster, it's just simply that data couldn't be internalized as fast as it is today. So that's some of what we've seen also this week, right? Earnings data getting internalized immediately,
yes,
immediately creating effects on markets, or for that matter, like some technical items that we were talking about before the show, which we don't have to go into today, but I think that there were some technical reasons for, let's say, Tuesday's rally earlier this week as well. But, I think it's a good idea at this point to flash, a little bit of a chart about, timing, what happens to markets amidst recessions and bear markets and things like that. And really, comparing the length of the recession itself with the market trough, and what the forward 12-month returns were in the S&P 500 following that trough. And I just point out two things. Once again, we said, don't run, don't panic, and stand your ground, right? It's going to be very difficult to time this, but something that we've talked about on the show often is that market will hit its trough long before usually the end of the recession, right? And it will take a while. The market will bottom before those lagging economic indicators tell us we're out of the recession. So waiting for the recession to be over to time your entry back into the market is not necessarily the best thing to do. And quite frankly, we think investors should stand their ground and stick to what I always say, their financial planning driven investment allocation as well.
No, I agree. And so that kind of gets back into, well, again, we've had this nice pause, here in the mid-year. This is normal. I mean, yeah, we're going to have that. The market's going to only go down so much before you have a pause. And I thought you saw some short covering. You saw some people trying to put money back to work. And we'll talk about that in a moment. But let's get back to some of our longer-term trends. And I think one of those, if you look at, we've had globalization for the last few decades. I mean, that's been the big theme. It's created more of a deflationary environment. It's created cheaper products for everybody. everybody. Now we've seen that big shift in the last year. Inflation, everybody's feeling it. There's nothing you can buy today that's probably cheaper than a few years ago. So everything's more expensive, and of course that's going to change in itself. But globalization is behind us, and I think a big change. And one of the things we talk about is now this deglobalization and this re-onshoring, which could be with us for a long time and really cause a change in things.
Well, exactly, Mike. And really what made us think about this as we prepared for the show is we thought back to, and some of our clients will remember this, is back in 2019, we really lined up some big macroeconomic themes. And one of those big themes was how the rise of globalization, free trade, et cetera, would bring inflation down. And throughout the pandemic, we've seen quite the opposite. Is it a political side effect? Sure. But at the end of the day, what people are looking for is bringing jobs back within borders, or at very least nearshoring. So, for example, the United States produces a lot of U.S. cars like Chevys and things like that in Mexico, right? It's cheaper to do it there. That's an example of nearshoring in and of itself. But the more and more of a push we get in that effort of deglobalization, the less pressure we get on inflation overall. And there are both economic and political arguments for and against globalization, but it's a really big trend because we highlighted it at the end of 2019. And I think what's happened over the last few years has flipped a lot of those themes on their heads, right? We and it's really driven down by three things, right? It's the fiscal response to the pandemic, it was the monetary response to the pandemic, but then also just rapidly changing consumer habits as well. What was important a few years ago, as I say, always, as I said often on this program, is what was true a few years ago is not necessarily true today in terms of trends. But we talked about deglobalization. Another thing that we highlighted at the end of 2019 was an accelerated push towards renewable energy sources and how that could put the petrodollar under stress, or at least the dollar standing as the world trade currency under stress, could bring the dollar valuations down, which we've seen the opposite here lately, but we can talk about that on another program or later in the show. But with that accelerated push, what has happened here is that transition has probably happened a little bit too quickly, right? We're seeing that in Europe right now with the geopolitical tensions and things like that. That's another thing in terms of long-term macroeconomic themes that can actually lift inflation higher for longer, is this accelerated push. We had, Biden's speech on climate change yesterday. You can read the tea leaves here and see both, from a political perspective, this is an important factor for a lot of voters, but then also it's for administrations around the world, it's becoming increasingly popular as well. It's just, unfortunately, we don't really have the capacity there to meet the demand, and that's going to put price pressure overall on energy.
Well, long-term, a great goal. I think everybody wants to see, a better source of energy. However, I think many of us realize there's a bridge to get there. Just over the weekend, you saw Biden talking about, to Saudi Prince, MBS, and, for the first time, we've always wondered what peak production would be in Saudi Arabia, and it basically kind of came out and said, well, that's around, 13 million per day. It's probably about 10.7 million per day now. So, you kind of look, this could create a current crisis, and we're already seeing it now. We got the heat wave across the United States. I fear for Europe in this coming winter and what that could look like. So be prepared for a lot of this, shorter term ramifications for these longer term goals and those themes.
We saw, the Nord Stream pipeline came back online last night, and I think that was in response to political pressure in that they're not building up their gas reserves for the winter, and they're burning gas like crazy to power what few air conditioners they have over there in places like the UK. So, God bless them, and, fortunately for us, we experience the same temperatures. We've got giant AC units. Sometimes it's too cold in our homes and offices. So
we're very fortunate to have that infrastructure. Yes. Well, I think another big one, Chris, another one of our themes was, the advancement of technology and automation. And I think, post-pandemic, seeing what happens when an entire workforce just shuts down. I think it's brought forth a lot of what's going to, what we will ultimately see. I think it's brought forth automation, and I think these are things we're going to continue to see going forward.
Well, and thanks Zoom, and things like that. There you go.
Peloton.
I think that, And at the end of 2019, that was one of our big themes. That again, a deflationary theme. As we get more and more, we call it that sixth wave of technological evolution. As we got more and more, advancements, we saw more and more advancements. We saw increases in productivity, more widgets per worker. A sort of trend like that, and that really helped, bring long-term inflationary expectations down. And I think that still rings true today. And in fact, the pandemic, if anything, it accelerated it. So while we've talked about a couple themes that have been flipped on their head and actually are now causing increases in long-term inflation. That's still one that can help keep things down.
Correct.
Another one, of course, is, potentially aging populations as well. That was another big theme in 2019. But at the same time, that's creating a side effect now in that there's a scarcity of labor, right?
Yes.
As more and more people age, and then we have rapidly slowing birth rates, but then also a lot of people who weren't going to retire, when the pandemic hit, they said, I'm not doing this anymore.
So that reduction in the workforce.
Exactly.
Yeah.
And what that does is that increases, immediate labor demand, that gives workers more bargaining power, that raises wages over time, and that can, of course, increase inflation, right? And that was one of the things we pointed out in 2019 as well, was the struggle between capital owners and labor renters, right? In layman's terms, that's just workers pushing for more pay, better benefits, whatever it might be. Again, the political tea leaves are moving that direction. Think about it, right? A few weeks ago, we saw Starbucks workers unionizing. We just got word here in Houston. There's a store here in Houston where the workers are looking to unionize and things like that. All of that pushes people, pushes wages higher, but then also the fiscal response to the pandemic. I've talked about it often, how that was effectively government-sponsored collective bargaining. It gave workers the confidence to say, I don't need to go get a job right away. I'm going to bargain for better wages. I'm going to go out and look a little bit harder. And that's another inflationary or long-term inflationary pressure trend, if you will, which, it's something we pointed out back in 2019, but it's certainly been exacerbated by the fiscal response to the pandemic. And then, I think if we just continue to talk about, some additional long-term themes, moving away from technology, labor, and things like that, let's talk about central banks, right?
Yes.
Central banks are out of ammo, at the end of the day, right? They're struggling between fighting inflation and spurring growth or creating growth. Well, those two things are mutually exclusive, right? You can't create growth and stop inflation, right? You're raising rates to stop inflation, you're dropping rates to create growth. They want to do both at the same time, and it's very difficult to do so. And then also less fiscal support, right? We spent trillions of dollars over the last, 3 or 4 years fighting this pandemic, probably more than we needed to, looking back in hindsight, at least. Hindsight's always 20/20. But now they have less weapons at their disposal to spend to bring, the economy out of recession or downturn or whatever it might be. So those are some of those long-term themes, that new long-term themes with respects to monetary and fiscal policies, maybe rising wages, but then also how some of our original themes have, the world was turned upside down right after we issued those, and some of them are still true today, but others, the narrative has completely changed. I think it's important that we point that out.
Well, and so that kind of brings us into, investment implications,
Yes.
right? So what do we think going forward? I mean, and I think this is where, here at Avidian and our investment team and some of the shifts that we make in the portfolio are reflecting these. I mean, again, back to that narrative being a much quicker narrative shift than we've seen in the past. You have to be, I guess, on top of things much more than you would in the past. But going back to the financial planning, staying within your bounds there, but there's a lot of things that are going to change that could be exciting on the investment front, but also things that could be, it could definitely be pretty dangerous and scary and challenging.
A challenge as well, as portfolio managers, right? We want to be ahead of the curve, right? We want to be positioning portfolios in anticipation of these new investment themes, the implications that those long-term macroeconomic themes have on portfolios, right? So the first thing, of course, is a steeper yield curve, what we were anticipating,
Yes.
right? You've got higher inflation, you're going to have a steeper yield curve. That could be good for fixed income investors, but the problem is that it doesn't matter how much your bonds are yielding. If you're lagging behind inflation, you still need to find replacements for sources of income, something that you and I have been talking about since we started working together.
Correct.
Many years ago. And then also, higher equity risk premiums. In layman's terms, that means investors are going to look for better valuation metrics with higher rates and higher inflation, right? The ZIRP environment we saw over the last few years has really propelled those tech stocks higher, right? You had said at the beginning of the show, you said, you can't think of a thing that it doesn't cost more today than it did a year ago. Well, I'll tell you one thing. Netflix stock, all those kind of things.
Yeah, well, stocks, absolutely.
Yes. Tech stocks especially, right? Those are, in some respects, you can still get quality in that sector, and there's still some momentum there, but it's just, a fun little adage there. But then, I think that value investing is probably likely to outperform, here in the here in the near term. Yeah, back to flight to quality, right? It's when rates go up, when financial conditions get tighter, going back to Kevin Lennox's, index there, you typically want to own more quality in your portfolio. And I think quality will be a bigger and bigger, staple. And that's largely because we saw so many zombie corporations over the last few years, companies that had no real cash flow, no real revenue or anything like that, but they were worth $300 billion on paper.
Well, because of zero interest rate policy, they were able to keep kicking the can down the road. Now that that's changed, those zombie corporations could be coming up a lot faster than what they've been seeing.
Yeah, it is a kind of a trap in and of itself. And I think that the biggest investment implication of everything that we've talked about so far is the increasing correlation between stocks and bonds.
Yes.
That's what we've seen, and that's why we've really advocated for replacing fixed income, but also diversifying your growth streams, right? It's created a massive demand wave for things like, real assets, so physical assets, whether it be precious metals or real estate or whatever, infrastructure, funds, things like that, whatever it might be. You need to find ways to diversify your growth streams. That it's not that the 60-40 is dead, but what's in the 60 and what's in the 40 has completely changed. It's not just 60% S&P 500, 40% bonds. You have to diversify both sides of the portfolio more so than you were before because of that increase in correlation between stocks and bonds. And that's something that, I think that we've been proactive about, but it's important that investors continue to be proactive about and continue to add those new streams of income and growth to their portfolios.
So putting money to work, a recent question I had from a couple clients, or some potential clients with money on the sidelines, where is that entry point? And while it's pretty scary, and it's a hard thing to talk about because we're very close potentially where it could be announced and it'll be lagging that we're in a recession, right? You got the GDP now basically forecasting another the second quarter negative GDP. So if that happens, technically we're in a recession. But the market's probably, in my opinion, priced in about 75% of probably the volatility that we're going to see. You got to be prepared for that, that other, bit of volatility, and that can come from a lot of things that we've actually mentioned. But I think it's not a bad time to start looking at what maybe could be some good entry points. I think dollar cost averaging is certainly the way to go. But what are some other thoughts on maybe some entry points, and we'll kind of wrap it up?
Right, exactly, Mike. And as we said, timing this is going to be very difficult. The narratives are shifting faster than they ever have before. Averaging into the market is still probably your best strategy. Continuing to contribute to your 401ks, that's your best automatic averaging you've got. But then in terms of near-term entry points, there's definitely some end of seasonal weakness coming up. Summer's typically seasonally weak. We get into the Santa Claus rally period, the fall rallies. So that could be a good entry point looking at September, something like that. But then also the 2023 earnings reset. And we've been seeing this play out in front of us over the last, 5 to 10 trading days as Q2 earnings have come out, right? Companies are actually reporting pretty strong earnings. It's some of the fuel for the rally we've seen this week, or at least just the pause and the destruction we've seen this week. But what they're saying is that forward guidance is not looking very good. You see everybody from Apple to Microsoft all saying, hey, we're not hiring as much, we're not investing in growth as much, we're not in general, we're not spending as much. And so as those expectations get priced in, as you said, 75% of the way there, as those expectations get priced in, there's a good opportunity to put some money to work. And then, of course, like you and Kevin pointed out on the last show, and as we've talked about this year on the program, the Fed's dovish pivot, right?
Absolutely.
And in response to the recession, unfortunately, that'll be a lagging item that happens,
yes,
right?
It will.
They'll say, okay, you're in recession. I think we've got enough ammo in the gun now. Let's get a little bit more dovish. Let's pause, our rate hiking cycle. We'll get the next hike here pretty soon to see, where that lands in terms of, what the Fed decides to do. We saw the ECB hike rates today, 0.5%. And that's definitely, going to create some additional economic, implications here going forward. We talked about a strong dollar and things like that. Will that affect the dollar? There's just so many. I think what we're getting to is that there's so many different factors out there, and that's why we really wanted to focus on the long-term themes in today's show. But then also why it's important, of course, to stand your ground and stick to your financial plan, as we always say.
Yeah, we'll definitely be keeping you well informed here, on the show and throughout the year. I want to thank you for being on the show today, and we'll definitely we'll have you on next month, and we'll talk more about some of these changes coming up. Thanks for tuning into Lowdown, and have a great day.